we're going to move forward now and talk about the outlook for ESG. And we've got a really outstanding group of panellists here to talk about both the philosophical and the technical aspects of that across investment, engagement and sentiment. So with us today, we have Sakin Nasebi, he's the CEO of Federated Hermes. Nikesh Patel is the CIO of Van Lanschot Kempen. Erin Leonard, the head of sustainability at HSBC Asset Management. And Jasbir Nizar, who's Global Head of Business Development at Lombard Odier. So I just wanted to start off, I mean, it's been a wild ride for ESG over the last year, ending with COP, which has just finished, and keen for your views on that in due course. But really, what do we see as the main focus areas from your perspective for ESG going forwards into the next year? Saka, shall I start off with you?
So I'll keep it short to give my colleagues time to respond in their own way. I'd say we now need to decide what ESG is. When the firm that was Hermes before me started down the path of ESG, they were very clear it was a way of investing for enhancing returns and giving back to stakeholders at the same time. Since then, it's become trendy starting in 16, 17. It's taken on this view that it's a sort of a separate product. You have this divergence between Europe and the United States. And I think people are quite muddled about what it really is that we're talking about beyond the few headlines. And you mentioned COP, which concentrated on carbon, which is important, but biodiversity should be there and other factors. So I think it's the year in which we define what it is that we're talking about.
Nikesh, would you agree?
Well, I completely agree also with focusing on biodiversity a bit more, given there is no solution to the climate crisis without solving biodiversity first, and it is first and then climate. But the second thing I would say is ESG, or whatever you call it, has something of a communications issue to solve. It's been a rough ride for ESG. It is the right thing to do, but when you've had a rough ride, you have to explain and defend and continually justify why it remains the right thing to do.
So following the theme I think that we are establishing, I think, first of all, it's hard to think of one area of focus. It's such a broad platform, and there's so many discussions underway. But for sure, the challenges and the debates around regulation as well as greenwashing risks, they just haven't run their course yet. But I think with that said, we can be encouraged to see some directional developments with some of the regulations like SDR, with the consultation coming up with SFDR, and another example would be the taxonomy that's coming out from Singapore. And these developments are putting more emphasis on sustainability contribution and the positive impacts of investing, and hopefully as well the concept of transition economy and the returns and investment opportunities that are associated with that. So as the dialogue evolves, I hope we'll see more emphasis and interest in those parts of the debate.
I think, contrary to what Saka said, I'm going to say that I think ESG among investors is understood. I think what's misunderstood or not clear enough is sustainable investments. And so I think that they're two separate things and we shouldn't conflate them. I think on sustainable investments, what's really important to understand are what are the key system changes that are going to be relevant for investors. So I think that's point one. And I do think that in terms of the regulations, the data quality, some of the financing the transition and how we get there, I think that's the key areas for focus.
Very good, thank you. Nikesh, I'm actually going to pick up on something you said about the communication challenge that it faces. Do you mind just elaborating on that a little bit more?
Sure. Well, we've seen 18 months of elevated energy prices, and therefore, as you might expect, energy companies have done well. Energy companies tend to be underweighted in most ESG indices and most ESG portfolios. You might hold some of them because you want to engage with them, but generally they will be underweight, and therefore most ESG indices or responsible investment funds or managers that prioritize those things will have been underweight a very high-performing sector and a very material sector of the global economy. They will therefore have underperformed. Now, that's an understood reason, and there is an ongoing reason why you should expect those companies over the long term to underperform, but that requires a defense. Because ESG isn't just about in an ivory tower, us deciding that it's the right thing to do and then telling the world this is what we're going to do. The world may not agree, people may not agree, pension members may not agree, retail investors may not agree. They may look at different metrics like the one-year performance. And that could incite flows which are driven by performance and not a more rational view of investing.
That's interesting. Is it the battle between the sort of long-term focus of ESG and the short-term sort of track record that we currently facing?
If I may, I think that's exactly the point. So so when I say we need to define what ESG is, what I mean is this. Look, if you think ESG is separate from, or sustainability, if you want to call that, or if you mean by sustainability impact, but let's use ESG shorthand. If you think it's separate from mainstream investing to make money, you have just excluded the entire pool of investment out of the United States of America, because it's illegal to invest in anything other than to make money, right? It's just the law. By the way, it wasn't that different over here. It's just we allowed pension schemes to look at ESG. So the first element is you've got to look at it as actually being just normal investment. It's a factor of investment. The second part is at what time horizon. Back in the days when I was a growth fund manager, you could say that for growth to pay dividends, actually the same is true for value, you need a longer time horizon. The problem is that the market, more and more recently over the last 10, 15 years, is more obsessed with short-term horizons. And that therefore creates the discrepancies, and that therefore brings up the debate, and then that therefore kind of adds fuel to this fire of debate of it is, why is it that you integrate ESG in what you do? Why is it that you actually integrate sustainability? Why do you look for sustainability fund? Is it because you want to save the world? In which case, who gave you the authority to? Or is it because you think that that's the only way that you can make money in the long term? In which case, that's just a factor of investing. Mm-hmm. That's what we have to clarify.
So on the the short term, long term, I think you can almost divide the client base in two. I think for wholesale clients, it's very much, the performance, quarter, annual, what is it doing? I think for institutional clients, pension funds, it's much more, at least when we talk to institutional clients, it's very much a medium to long term conviction. So they're not necessarily going to look at performance right now. They also look at mandates, so very different in terms of their expectations about how a fund is going to look. And I think that's perfectly aligned to sustainability. It's a long-term transition. And so I think people that are looking at it short-term outputs, returns, may be disappointed this year because the performance hasn't been there. But for a lot of clients, it's a conviction. When you're convicted on something, my view of conviction is, you're locked in. And I think for a lot of those investors, the long-term ones, it's fine. It hasn't been an issue in terms of the short-term performance.
That sort of aligns with what you were saying, Erin, in terms of the thesis being the transition.
Yes,
actually,
absolutely. And for those of us that work in this space regularly, it's you ask yourself some common sense questions. Do you really think that the energy system in 10 years' time is going to look the same way that it does today? Well, for those of us, we think not. Therefore, you need to think about your investment allocations. And as Saker said, it just becomes a normal part of investing. But I think your point about retail investors is an important one. And I think that there's a lot more that we need to do as an industry to bring this into the retail investor consciousness and into the pension beneficiary consciousness, so that they see this as well. Yeah.
I was going to raise a potential parallel. Most people can divide themselves into value and growth investors in the equity market. There are some very painful times to be a value investor. It takes a lot of faith and trust for those of us who are value investors to stick out decades and wait for the next time that value is in favour. We're going through the first major version of this for ESG, a large-scale time period where ESG has underperformed, and it is for those of us who believe that it is the right thing to do, actually aligns very well with value, in fact, that this will continue to be the long-term driver of returns, and not just give up because over the short term it has disappointed. Like value, often over the short term, and growth, often over the short term, will disappoint.
If I may, this is not about ESG, but about long-term versus short-term. So there were a lot of academic studies done, and the truth is that if you are very short-term oriented, you're making directional bets on the market. And statistically, this does not work. It just does not. And there's a huge amount of stuff out there. And the returns, here is a statistic, the returns for a professional poker player in Los Angeles is far superior to most people who bet on short-term trends in markets, actually taking as people investing in the stock in funds in the United States, which are short-term funds. What does that mean? It means that, yes, investors, particularly retail investors, are buffeted by short-term, and whether they believe in ESG or they do not believe in ESG is irrelevant. Our job, in some ways, is to try to convince them that if they really want to make money, they should go from gambling, which is what short-term bets are, to investing, which is sort of what, I'm so sorry, which is what Jashir says is about, I don't know how to turn off this phone. What Jashir said is the difference of long-term investing is about conviction investing for the very long time. So that's what we go. Try to turn this thing off.
I'll leave you to take that call, Sir. We have to touch on it. The anti-ESG movement has been very strong this year, although you may have seen some of our research being displayed out there. 9 out of 10 investors believe that will be transient, actually. Does the panel believe that that's the case? Does it see it as an ever-going thing against the ESG movement, or is it transient?
So I'll start with this and I'll pass on. Look, I go back to the first point I made. Under American law, that's half of the world's investment. The law is very clear. Under fiduciary law, you're only allowed to invest for making money. Actually, particularly for pension funds, and even if your client asks you for other things, they have to pass very high hurdles to be allowed to do so. Now, the reason we can do what we do as Federated Hermes in the United States is we had a paper published which looked at what we do by a professor of trust law at Harvard Law School, Professor Sitkoff, and another professor. And what we argued is by putting sustainability, ESG factors, we enhance returns over the long term. Therefore, we pass muster. But this war between anti-ESG view and pro-ESG view has to resolve in deciding whether it's a way of making money for the investors, as well as a conviction for doing good. Because there is a split. In Europe, people want to do good, but in the rest of the world, Asia and the United States, they're not on that same wavelength yet. We've got to bring them together. That's the key.
I think in Europe, the same fiduciary responsibility exists. So as asset managers, our primary fiduciary responsibility is to generate returns for our clients. So that's point one. That's our, reason for being. I think point two is, also Erin touched on it, is educating clients about long-term investments. And I think we also have a fiduciary responsibility to do that. To answer your question, yes, I do think it's transient. I think that investors have been slightly cautious just because of equities. And having said that, the other debate to have is the active versus passive. And so whereas we haven't necessarily seen flows on the active side, there have been flows on passive. So that's still happening. And I think it is transient even on the active space. So you mentioned COP. I thought yesterday's announcement was a good signalling and indicator for the markets as well. That, those energy systems are going to be worth investing in over the long term. The land and oceans, I think it was touched on the last panel, green bonds, blue bonds. There was a lot of progress made on that at COP, some of which didn't get picked up, and then all of the impact on the materials sectors as well, as that whole transition is financed. So I think people are looking for those signals, and now that they're coming through, the sentiment will shift.
Sorry, but note our discussion. We're talking about carbon, we're talking about biodiversity. We've mentioned nothing about the diversity of gender, the diversity of ethnic background, the diversity of cognitive diversity. We've talked nothing about the impact on communities. We've talked nothing about the governance of companies. So note how the debate about ESG, even amongst practitioners who know more about it than most other people, actually find ourselves being funneled down this very narrow, very, very narrow part of what it's about. And I go back to my main point. The reason that you want to employ this is because it's the sensible way to invest. The reason that I believe in gender diversity is it's financially stupid not to, and we can talk about that later. It's not because it's the right thing or the more, it's just financially stupid. And ESG is a much more holistic way of looking on how companies interact with the communities and the businesses that they engage with, and how they increase their returns over the long term, rather than being focused on one aspect of belief or another, because that's slightly separate, I think. It does have a positive outcome, but that's not how it started, and that's the debate.
But I think as well, just following that, so your original question was, is the ESG backlash going to continue? I think this version hopefully will play its course quite soon, but I think for the factors that you've just mentioned, Sacco, there's going to be a lot of debate in the future, different debates around sustainability, because we've only, as you've just alluded to, we're kind of, I don't mean to say that climate is the easy part, but it's almost a single factor or few factors, whereas once we start to bring in social communities, et cetera, the considerations are going to become immensely more complex. It's not black and white answers, and investors such as ourselves are going to have to grapple with really challenging decisions and balancing these factors.
And I would say sorry, you wanted to come. Just one point, but I think the gender point is firmly centred in the climate debate. You can't get away from it. 80% of climate migrants are women. And so, when you look at that fact and you look at the fact that they're displaced from their communities, they're subjected to violent crimes, their education is disrupted, they don't have access to finance. You fix climate, there's a lot of actually positive knock-on effects. But
I agree, but what I'm saying is, let's look at the developed country, the United States of America. Look at women's rights in the United States of America. Let's look at this country. How many senior women do you have in senior positions? Let's look at companies in this country. What I'm saying is, not to have gender equality is stupid. Why? Because they're half the population. I mean, duh, right? I mean, it doesn't need more than that. Let's not overcomplicate it. Why do we believe in ethnic diversity? Look at London, right? 40-some% of Londoners like me were not born in this country. We're a bunch of immigrants, right? Look at this panel and how we're split. Come on, duh. I mean, let's not go into... Now, of course, once you go to developing countries, there's a bigger impact on certain communities than others, on certain genders more than others, on certain ethnicities more than others, right? But the basic fundamental reason that you believe in these equalities is that it makes better economic sense in the long term, which is the question that you said.
Well, if I can ask the question, I'm going to disagree with the panel. I don't think it's intransigent. I think the anti-ESG backlash is here to stay, and I think it's here to stay in the same way for two reasons. The first is politically, it suits the various forms of populism we have around the world. It is an enemy that you can point to with not a clear target. So you can say what you like, and you're not really pointing someone to one specific thing that you can fix. The second reason it won't go away is we still have flat earthers. It's hard to kill an idea. So that resistance will remain. But on the other hand, I'm not overly worried about that, because I think most real investors think, as Sacco has described, we do think over the long term, we take these things into account because they make financial sense to take into account. So whether or not people talk about it, whether or not people have a backlash, doesn't stop the fact that this is the right thing to do, both financially and in generally the right thing to do. And then just to give maybe one bit of good news, you've seen a lot of people who sell to both Europe and the US almost change their marketing. I allocate to hundreds of external fund managers. I can see that those managers have stopped talking about ESG. They've stopped talking about in their marketing decks that they do this, and it's all, wonderfully impactful, because they know that that's going to get them a red line in the US. I know they still do it. When I speak to their analysts, when I speak to their teams, I know they still do it. But they've stopped talking about it. It's almost the reverse of the lip service conversation I think we had last year on this panel. So you're actually seeing a rather positive effect. You're seeing the actual investors do the right thing, and letting everyone else talk, but continuing to do the right thing.
Well, thank you, Nikesh. We want a panel that disagrees and provides that kind of debate. But moving on to sort of data, and this is perhaps why climate has been so heavily focused on, because there's now provision of climate data and TCFD reporting obviously being mandatory in the UK. Nikesh and Jazz, I just wanted to get your opinions on whether you feel that TCFD reporting or climate data is decision useful from an investment perspective, and if not, why not?
So I don't think the data is all that useful, and you can go shopping for better data. If you want a better score, just pick a better provider or pay them or whatever. I mean, data itself is not reliable because you can go shopping for data. There is no single source of correct, so that's a problem. Are TCFDs decision useful? No, they're a tremendous waste of money and time, but they force attention on an issue which needs attention, and the outcome of every TCFD report, by the way, is the same. Climate's going to kill your portfolio. Do something about it. You didn't have to spend 100,000 on the report to get to that outcome, and that's being very generous on the consultants who produce those reports. So is the report itself decision useful? Not at all. But it has resulted in the right outcome regardless. People are taking awareness of an issue and they are taking action, not because the report says do this specific thing, which is what I regard as decision useful. Because my God, if you took specific actions based on the TCFD report, you'd have to be nuts. But they take the right action in general. They look at their portfolio, they consider resilience, and they change their investments accordingly. Or they at least think about the time horizon directions. But they do something useful with it. And to that extent, I hope with TNFD they've learned a lesson. Don't create an industry around creating a report. Just get to the end point. Get to the useful part. Skip must be hundreds of millions in between of cost to develop the report and the standard of that report. I'm
going to slightly disagree, but we'll pick it up from where I do agree with you. I think that, I think TCFD is very important. And before that, there wasn't a common understanding of what needed to happen in portfolios. And looking at temperature in portfolios, looking at how do you decarbonize. So I'm going to say that it was very helpful, very instrumental in forcing that discussion to happen. So people are looking at it, whereas before it was all over the place. Where I do agree with Nikesh is just on the quality of the data. And so I have an issue with those data providers because a lot of the data is backwards looking. And oftentimes they just rely on the company's reports to give a rating, and then that's what features. So the bigger the company, the better the rating is going to be, and that's what they use. The key point is the transition is ahead of us. And so therefore, if you want to decarbonize your portfolios, you have to look at forward-looking metrics. And so I think that's where we need to go to. And I think that's the bit that, people that are managing these portfolios are not necessarily looking at. So I think that's the future. And that's where the shift needs to happen. And maybe those TCFD reports would actually look better if the right metrics were being used.
Well, hopefully this is something that can be passed on to other ESG aspects, including the TNFD as well. And I don't know whether, Erin, you think there's any learnings that we can take from climate over the last few years and apply to other ESG issues such as biodiversity. I know that's a major focus for HSBC.
Yeah, well, I think, this may be stating the obvious, but with biodiversity, the issues are immensely more complex. But I think now is the right time for the industry to really start to put focus and assign resource to the issues around biodiversity. I think that with TNFD just coming to play, with Nature Action 100 just getting off the ground, with the Finance for Biodiversity Pledge, which is a major industry initiative that was launched several years ago, that's going to require signatories to start to make public commitments on that in 2024. So there is a lot of coming together now around biodiversity. And of course, it is absolutely a critical pillar of the overall net zero solution set. So I think that there are probably a huge number of learnings from climate, but maybe the important part is to realize where we are right now, and that this is going to be a multi-year journey. And what we actually need to do in the first instance, the first job, is to get companies to start to report and to start to disclose. And so the fact that their disclosures will probably be highly flawed is no doubt. But getting companies moving now is the point.
Is that going to be one of your engagement areas of focus for the next year?
Yes.
And sort of how much leeway are you going to give corporates on that?
Well, I think again, if the first job is just simply to get them to report and disclose, you've got to give them some time to. We're just getting started from an investment perspective. We're just getting started understanding the issues. Developing the standards, the best practices, what good looks like. So yeah, we've got to give the system some time.
Very good. And I wanted to ask a philosophical question before we head into questions from the audience. Saka, ESG and purpose are often intertwined. They both had a bit of a backlash recently. Do you think that marriage between the two needs a divorce or a renewal of vows?
I think it needs clarity. We go back to clarity. Look, some people who invest in impact, sustainability, call it what you want, do so out of religious conviction. That is fine. But my religious conviction is not the same as yours, is not the same as yours, is not the same as yours. And I have no right to impose my religious conviction. This is why I bring it back to this makes sense from a pure investment point of view. Now, I can appeal to your hearts. Years ago, when we started in this journey in what was then Hermes, I'd often start these things like this, saying, I'm going to appeal to your hearts. And it actually didn't make any difference. And then I'd appeal to your wallets. I've now reversed it. So I appeal to your wallets first by telling you it's a good investment perspective. But let me appeal to your hearts. So let me go back to biodiversity. All of you here, take time over the next Christmas holidays and go down to the Natural History Museum. Great institution. 150 PhDs are doing research on the death of diversity on our planet. Talk to them. They'll scare the bejesus out of you. We'll be long dead as a species, long before Westminster is back to marshland. That is the heart bit. But where we've got to get to, if you like, is the wallet bit, which is to say to companies, look, the market is going to move there because actually people will care more about it, because people will move, because the regulators and governments will move like they've done with carbon, they'll do so with biodiversity and other things, because it makes sense. And that's where we have to combine that purpose. Now, come back to just pure purpose. We're human beings. We always do things as human beings because of purpose. Otherwise, life is worthless. And actually, all economic decisions are based in part on human endeavor and human want. And the most misunderstood man in economic history is Adam Smith. And people go on talking about his Wealth of Nations and never read his moral philosophy, right? He was a moral philosopher. The guy assumed that the reason you enter markets is because of purpose. So no, there wouldn't be a divorce. I think there has to be a clarity of, as agents, and that's all that we are on this panel, as agents, why are we doing what we're doing? And if we believe there's a religion we have to pursue for the sake of mankind, then we should advocate for it. But separate that from why we do our job that we do, because that is like proselytizing for a new religion. But purpose is key, because without it, we are not humans, we are machines.
Do any panelists have a response to that?
He's got it.
On moral philosophy, no.
Also, what you're saying there, Saka, is that actually, purpose ties into the UN SDGs.
Yes.
Is the future of ESG going to be more sort of thematic type investing, as opposed to just ESG integration moving forward?
I think it is one of many ways to disaggregate this. You can have one thing called responsible investing, or you can have three things, E, S, and G, or you can have 6 things under that when you come down the pyramid. The SDGs are a way to communicate to someone who isn't on this panel about what things matter to us. Because the SDGs are quite good because they don't require an expertise in finance to understand why, you speak to someone why biodiversity is important, someone who's not in our industry, they'll look at you blankly. Tell them, well, do you care about clean water? Yeah, they probably get that one. The SDGs are very good at making clear themes that you can then say to whoever you're investing on behalf of, this is why we're doing what we're doing, and this is why, by the way, this theme is really important. You know, clean water. Without clean water, 30% of the S&P 500 kind of disappears. It's one of their major inputs. You know, that kind of impact. The SDGs are very good if you need to communicate very easily and in a friendly way what it is you're doing, what you're trying to prioritize. It's no longer enough, I think, and it's a bit lazy actually for investors to say, oh, I believe in ESG, I'm going to prioritize E and do climate. Well, you know, what is climate? There's a million things you can do under that. The SDGs allow you to be a lot more specific.
Yeah. And just to add to that, I think the thematic can really help the industry in terms of 2 points. One is purpose and values, and the tangible aspects of investing sustainably for the end investors, for the retail investors. It communicates the purpose element of it. But then secondly, we started talking about the transition economy and the return opportunities. We need more themes that clearly tie to some of those investing opportunities. And so I think that thematics could help with some of the narrative elements around sustainable investing.
Fantastic. Well, we've got a bit of time for questions from the audience, so please do raise your hand if you have one. We've got one there.
I wondered what the panel thought. Sorry, it's Steve Clapham from Behind the Balance Sheet. I wonder what the panel thought about Donald Trump. I mean, how scared should we be? What do you think he will do? What do you think the impact might be?
Well, I won't say to anyone in particular. Obviously, you know, the panel is probably not likely to get into too political conversations. Does anyone have a response to that?
I do. I will give you a conundrum. I'm not going to answer the question. I'll give you a conundrum. So the most vocal voice in the, if you want to call it, anti-ESG movement in the United States is the state of Texas. Right? Very clearly. The treasurer of the state of Texas is very vocal, and I'm not saying anything that's not public news. Good look at how much alternative energy is as part of Texas life. It's one of the most advanced places in the world. So separate between, as you've heard, the political points being made and the actions being made. This is because I'm I'm a growth manager, so I'm always looking to the future with optimism. If I were a value manager, I probably would be slightly more pessimistic.
Well, I won't take a value tilt in it, and I won't cover everything else that Donald Trump presidency might entail, but if we take Donald Trump and climate and as one of the many themes of ESG, you don't need a Donald Trump to go backwards on ESG issues. He hasn't been president for a while, and we've gone backwards on ESG. COP, by any measure, was not what anyone would have hoped for. So whether or not he's there or not, I'm likely to be disappointed regardless. What it means for investors, though, is with COP and with a future Trump presidency, the prioritization of global governments will be away from these things. And whilst companies can take steps to address some of these issues, without policy you can never get to the end point of those things. What it means is that the ability to reach a 1.5 degree world or a 2 degree world, best case, in an orderly way is now slipping, and it's slipping and it's slipping and it's slipping. And at a certain point, as investors, you have to say, well, at some point there's going to be a reckoning, because somewhere people will realize it's an emergency, we actually have to stop. And it'll be more painful and more costly later on. So actually for investors, a Trump presidency, and even without a Trump presidency, just the rest of the world is doing quite badly on its own, you have to think about, increasingly, I'm investing for a disorderly transition. So that's the implication it has, not him specifically and not his policy specifically on this. There are a whole host of other policies I won't get into.
But Nikish's point at the beginning is key. Think about it. That means a huge number of the largest democratic country in the world looks like they're going to elect President Trump. You can't just ignore that. That is the democratic will of the people. So then if we fail to make a point about any policy you want to make, that's a failure on our part in making the rational argument for why it should be a policy that is pursued by these people, right? It's reality. Politics are reality. And I think reality, like Nikish says, will reassert itself because there's an inevitability to this pathway.
Very good. Lindsay.
Lindsay Stewart, Morningstar. I have a less political question. The value versus growth debate was mentioned by the panelists, and we've seen that ESG labelled products have tended to have a bias towards growth investments, large cap investments, those with lower carbon intensity. So I wondered what the panel thought as the way ESG is thought about develops. Do we think that relationship is structural, or that we'll see different schools of thought start to emerge on what constitutes an ESG investment? Will we see a broader slate of approaches being taken?
That is such a good question. That is such a good question. My personal conviction, and I have no view as to this is true or not, but I think by definition it's a growth-tilted product, by definition, because it tends, take everything we've said separately. Take what Jashir said at one stage. It's about the future and the delta of change. The future and the delta of change is what growth managers invest in, right? Take what we said about the change of the product that you talked about, the themes of future growth. That's what a future growth product does, right? Take about even the valuations. My personal conviction, and maybe that's why I like being in an ESG firm in some ways, the Hermes firm, is because it's a future-looking product. So I think it does have a growth tilt, but difference between growth and value, and that's a different debate, is often overdone, right? It's a matter of price. They're the same companies, it's just the price you pay for them.
But I would say in equities, there probably is a growth bias, but I would disagree with one of the other points you said. You said there's a commonality, a correlation with large cap. Perhaps in climate, yes, but not in other issues, not in biodiversity, not in gender. You find an enormous small cap bias. So some things I think are structural, but I think most of the other biases just tend to be biases of large funds or where flow happens to be, but they're not structural. I'd also, just to go to the growth value argument, all bond investors are value investors. A bond investor, when they're thinking and taking climate or other ESG factors into account, they're looking at it from a value perspective. And even if they're not the types of funds that you're referring to, as the earlier panel said, bonds are back in vogue. Bonds will constitute an increasing part of investors' portfolios. And so if you think about growth versus value, investors are, whether they know it or not, significantly favouring value today.
Very good. Are there any other questions? In the front.
Jazz, just picking up on something you mentioned earlier. By the way, UK CEO, sorry about that, George. Wrong title. But you mentioned part of your fiduciary duty being around education. Mm-hmm. So just interested to understand how do you go about that and quickly in order to mobilise the money we need to avoid, climate disaster?
It's a really good question. I think that a lot of the time when we talk to clients, the starting point is really helping them on the journey. I think, just from our perspective, and I will let other people comment, we have a 50-plus sustainable investment team. We have a partnership with Systemic, who are, I think, one of the, really, really respected on global system changes and what needs to happen to finance the transition, as well as Oxford University. So I think that, part of our role is really bringing the resources that we have, the partnerships that we have, helping clients to say, look, this is what the academic community think, this is what the scientific community think, this is what's happening, and we'll run programs to say, look, help people to really understand, what is happening and what's the transition, what are the key system changes, where do those investment opportunities lie. And I think the feedback from our clients has been they've just found that invaluable. The level of understanding and awareness is so much higher, and I think that is the responsibility for people that actually manage money, but to allow other people to take better investment decisions. And that's for pension funds, that's for banks, that's for individual retail investors. So I think that, Erin mentioned it as well. I think if we can just raise that level of awareness and education, people will take better investment decisions.
Thank you. You talked about how ESG has become very embroiled in the US culture wars and suffered for it. Do you see that having any likelihood of being imported into Europe? Do you see us going the similar way?
I think it already has.
I agree. Look at the debate we're having in the United Kingdom as one harbinger of how it's going. It's sad. But that's politics, right? And politics, everything is fair game, including good investment methodologies.
I'm a bit more optimistic. I don't see that. I think Europe is, much further ahead in terms of the US. I don't think it's a race to the bottom, so I think Europe should carry on spearheading. I think even in the US, you have the East and the West Coast, which are very much aligned, and then you have the deep red states. And Saka mentioned it earlier, but Texas is the biggest producer of renewable energy. And I think people don't understand that. And I think that, when you talk about the Inflation Reduction Act, I think that's baked in for the next 8-9 years now. So I don't see that changing. It's my personal view. And I think that, I think what the US is really good at, and those states as well, is capitalizing on the opportunities. And so I think even with yesterday's announcement at COP, I think people will be very quick to say, what are the opportunities? How do we accelerate this? So I think that I'm going to be optimistic and say that the US will catch up.
And I know you didn't ask me, but we do have some investor poll survey that says that 65% of investors in the UK believe that ESG integration can generate alpha. But only 36% of investors in the US believe the same. So it'd be interesting to conduct this in a year's time to see whether that has had an impact. Any more questions?
Hi, thanks so much for a really interesting panel. I don't have a very well-formed question. It's something I've been turning over in my mind for the last couple of days, and it's this notion of what I'm going to call quiet ESG, and I've heard from a few investors and corporates that they are pursuing efforts that fit in the traditional ESG categories, but because of all of the backlash, they're not framing it that way, and in fact they're going, I think, Saka, the way you described it, to just talk about from a values perspective, not values, value perspective. These are the investments that we're making. These are the ways that we're changing our value chain, our production. So it fits in that traditional model, but people are not talking about it anymore. Is there a world where we start to underappreciate ESG efforts because we're not talking about them when in fact they're actually increasing? And what does that mean?
Can I say that quite optimistically? I think that's really good. I would love companies, I would love asset managers, I would love everyone in the chain to stop at some point talking about ESG, because it is just part of what they do, as it should be. So if they're calling it quiet ESG because they're doing it as part of just good business practice, I would say that's fantastic. That's exactly what I want. Although at a certain point, there are also companies who don't do it and don't talk about it because they're afraid. Not that.
It might still be a bit too early to reach that destination, because we do need to do more investor education. But I completely agree that's where we all want to get to. I think even I am a sustainability professional, but I hope that in 10 years, maybe 5 years' time, my role will be less necessary because the change will have happened and all of this will just be business as usual.
Very good. Well, we're at time, but I just want to thank the panellists for their contributions and the discussion that we've had today. So round of applause, please, for the panellists.